With the recent volatility in the stock market, many are asking, is your money safe? The market is shaky, inflation remains stubbornly high, and experts are warning that a recession could be just around the corner. In August 2024, the stock market took a significant hit with $6.4 trillion wiped out from global stock markets, raising serious concerns about the overall health of the economy. For many, the term recession brings to mind fear of job loss, shrinking savings, and financial instability. But while the prospect of recession can be daunting, stay tuned till the end to discover how you can protect your investments and turn this uncertainty into a unique opportunity to boost your wealth. So, what's driving this high market volatility? One major concern is the recent sharp slowdown in US job growth that boosts unemployment rate to 4.3% from 4.1%, the highest since October 2021. In July 2024, the US economy only added 114,000 jobs, falling significantly short of the 175,000 new jobs economists had expected. Another significant factor is the unwinding of carry trades involving Japanese yen. In simple terms, a carry trade is when investors borrow money in a currency with low interest rates, like the Japanese yen, and then invest that money in assets with higher returns elsewhere, such as the US. The trader then stands to make a profit of 5% as long as the exchange rate between the two nations remain the same. However, as the Bank of Japan has raised interest rates, the yen has strengthened, making these trades less profitable. As a result, investors have been selling off assets to close out their carry trades, leading to dramatic decline in global markets. Recessions are never easy. They bring risks like declining asset values, increasing unemployment, and overall economic contraction. Investors often face volatile markets, shrinking portfolio, and mounting concerns about their financial future. With businesses cutting back and consumer confidence plummeting, it can feel like there's no safe haven. But here's the critical point. Riches are made in recessions. History shows that the most successful investors often thrive during economic downturns by making strategic moves when others are panicking. And today, we are diving into not just one, but two of the most debated strategies that investors use to navigate economic uncertainty. We are talking about the infamous buying the dip versus the ever-reliable dollar cost averaging. These strategies have sparked endless debates among experts and investors alike. But here's the million-dollar question. Which do you think is better? If you're finding this video helpful so far, don't forget to smash the subscribe button. It really helps support the channel and keeps you updated with our latest content. Now, let's kick things off by breaking down these two strategies. Buying the dip is a high-risk, high-reward strategy that involves purchasing stocks when the market experiences a significant decline. This approach requires patience as it involves holding cash on the sidelines and waiting for the right moment to strike. If timed correctly, it can lead to massive profits. Dollar cost averaging, on the other hand, is a more systematic approach. Instead of trying to time the market, you invest a fixed amount of money at regular intervals, rain or shine, regardless of the stock price. Let's say you have $1,000 to invest in a particular stock every month. If the stock price is $100 in the first month, you buy 10 shares. In the following month, if the price increases to $200, you buy 5 shares. Over time, you end up purchasing more shares when prices are lower and fewer shares when prices are higher. This strategy smooths out the purchase price of your investments and reduces the risk of investing a lump sum at a less desirable time. Now, imagine you're a god, able to predict the exact moment when prices hit rock bottom. Buy low, buy low, buy low. Logically, it seems like buying the dip is unbeatable. You're always getting in at the lowest possible price. But here's the kicker. When you actually run the numbers, buying the dip underperforms dollar cost averaging over 70% of the time. That's right, not even a god could consistently outperform dollar cost averaging. So, what chance do the rest of us mere mortals have? But why does this happen? Because buying the dip only pays off if you can predict a major market downturn and perfectly time your entry. The rarity of major market crashes makes it challenging for buying the dip to consistently outperform dollar cost averaging. Let's look at the history. In 1987, we had the Black Monday crash with losses of 34%, followed by a remarkable recovery of 417%. 13 years later, in year 2000, the dot-com bubble burst, resulting in a 49% loss and a 101% recovery. 8 years later, in the 2008 financial crisis, saw a 57% drop and a recovery of 326%. And finally, 12 years later, in year 2020, the coronavirus crash led to a 36% loss and a 118% recovery. As you can see, events like this are incredibly rare, making it difficult to consistently rely on buying the dip. Even when buying the dip does outperform, its success relies heavily on flawless timing. Missing the market bottom by just 2 months can slash your chances by beating dollar cost averaging from 30% down to a mere 3%. From 1995 to 2018, the buy the dip strategy did have an edge over dollar cost averaging, though as you can see, the difference was quite narrow. This outperformance can largely be attributed to the significant dip in 2009 after the financial crisis. However, it's crucial to note that this scenario assumes a very specific and fortunate set of circumstances. Having the foresight to stay out of the market for 9 years since year 2000 and then perfectly time your entry at the bottom of year 2009. In practice, consistently achieving this kind of precision is close to impossible. Waiting for the perfect dip just isn't worth it for the small advantage, and chances are you will miss it entirely. Since 1872, bull market lasted a median of 42 months, with median price spike of 87%. However, bear markets only lasted a median of 19 months, with a median price drop of 33%. In a nutshell, bull market historically last twice as long as bear markets, and prices rise more than double of what they have tend to fall in bear markets. The reality is, while you are holding out for the next market bottom, the market will most probably continue rising, leaving you on the sidelines with a pile of uninvested cash. Dollar cost averaging, on the other hand, ensures your money is always at work, consistently generating returns regardless of market fluctuations. As legendary investor Warren Buffett once said, the stock market is designed to transfer money from the active to the patient. This quote perfectly emphasizes on the importance of patience and discipline in investing. Additionally, frequent trading and attempting to time the market can lead to losses. So, how can you fully harness the power of dollar cost averaging in today's volatile markets? The secret is to play smart and stay safe. And when it comes to making the most of your investments, the S&P 500 is your go-to choice. Consider the Vanguard S&P 500 ETF, ticker VOO, boasting a stellar historical record and annual returns of 14% since year 2010. Just look at the chaos of the coronavirus crash. Despite a 36% plunge in just 1 month, the S&P 500 bounced back with astonishing speed. Within just 5 months, it not only recovered its losses but surged to new all-time highs. Investing in the S&P 500 with dollar cost averaging means you're tapping into a robust, diversified portfolio that stands resilient even in the stormiest market. A $500 monthly investment in the S&P 500 over 30 years, assuming a conservative return of just 10%, you will be looking at over $1.1 million. In times of market volatility and economic uncertainty, it's easy to get swept away by fear and make rash decisions. But market doesn't reward panic, it rewards patience. So stay the course, stick to your plan, and employ dollar cost averaging, which is a proven method to weather the storm and build wealth over time. Rather than obsessing over the market's bottom or attempting to time your investments perfectly, focus on what truly matters: consistency and disciplined investing. Don't let the fear of looming recession paralyze you. No one can predict when it will hit or how deep it will go. The real danger isn't the market's ups and downs, it's not investing at all. Sitting on the sideline means missing out on potential growth, compounding gains, and watching inflation chip away your hard-earned money. Keep investing, let your money work for you. And if the market dips, seize the chance to buy more quality assets at a discount. Remember, the path to wealth isn't about timing the market, it's about time in the market. So stay the course, trust your strategy, and let your long-term vision guide you to success. So let me know in the comments, how do you manage your money during a crisis, and what other financial topics you would like to see. Don't forget to smash the like button and subscribe for more insightful content. Thanks for watching and see you in the next video.